Hello dear CA final students. In this video, we are doing CA final financial reporting RTP for May 2024 attempt. So most of the RTP questions are very familiar to you, and we are also getting an idea about how this case studies MCQs are. So without wasting time, we are getting into the session. So questions, case scenario 1. See, from the first question, we have 5 MCQs. But listen carefully. This first question is having 3 separate case studies. First question is having 3 separate case studies. And from that 3 case studies, we have 5 MCQs. And that 5 MCQs are not given in the order. It's spread over. Maybe question number 1 is from first case study. Question number 2 is from maybe second or third case study. So what I am planning to do is I'll read this case scenario 1 and case 1 and we'll do the related MCQs. So listen carefully. FA Limited is a company which manufactures aircraft parts and engines and sells them to large multinational companies like Boeing, Airbus Industries Limited. See, as I always say, there are some general paragraphs which are actually no way related to the case studies. Some general information. Okay, fine. Following are the details of some of the transactions entered into by the company. On 1st April 2012, the company began the construction of a new production line in its aircraft parts manufacturing shed. Costs relating to the production line are as follows. Cost of basic materials, list price 12.5 lakhs, less trade discount 20%. So I'm just checking 12.5 minus 20%. Yeah, 10 lakhs can be capitalized to the asset. Recoverable goods and service tax incurred but not included in the purchase cost. Refundable taxes cannot be capitalized. Employment cost of the construction staff for 3 months. Employment cost, yes, it can be capitalized, but remember whether it is actually related to 3 months. When we read the additional information, it is given that production line took only 2 months to make ready for use and brought into use on 31st May 2012. Okay, so this expense is incurred for 3 months. So divided by 3 into 2. Because if construction period is only 2 months, expense relating to that 2 months only can be capitalized. Yes. Other overheads directly related to construction. Yes, directly attributable expenditures can be capitalized. Payment to external advisors relating to construction. Yes, again, relating to construction can be capitalized. Expected dismantling and restoration cost. Present value can be capitalized. Okay, fine. So production line took 2 months to make ready for use and brought into use on 31st May 2012. So April, May, 2 months is the construction period. The other overheads were incurred during 2-month period. Okay, other overheads were related to that 2-month period. Perfect. So that overhead expenses can be capitalized. They included an abnormal cost of 0.3 lakhs. Caused by a major electrical fault. What do you think? Can you capitalize this abnormal loss? No. Abnormal loss cannot be capitalized. So overhead expenses include other overheads 0.9. This include 0.3 abnormal loss. So what you can capitalize is only 0.6. Okay. The production line is expected to have a useful economic life of 8 years for depreciation maybe. After 8 years, FA Limited is legally required to dismantle the plant in a specified manner and restore its location to an acceptable standard. Restoration expenses they are talking about. The amount of 2 lakhs included in the cost estimate is the amount that is expected to be incurred at the end of the useful life of the production line. Okay. The appropriate discounting factor, yeah, this is what we need, 5%. And the present value of rupee 1 payable at 8 years at a discount of 5% is approximately 0.68. They are so kind, they have given you the discounting factor at the end of 8 years at 5%. So 2 into 0.68, 1.36 is the present value of this dismantling cost which can be capitalized. 4 years after being brought into use, as I always say, you should have that patience to read or complete the question, having that track, presence of mind. 4 years after being brought into use, okay, the production line will require a major overhaul or inspection to ensure that it generates economic benefits for the second half of its useful life. So which means at the end of year 4, you need a major inspection, which is to be, what is the treatment of major inspection cost, major overhauling cost or major inspection cost, which is to be capitalized. If you want to capitalize at the end of year 4, what the standard says, if you can remember, recollect a question of ship having useful life of 20 years or major inspection cost having life of only 5 years. So from the total cost you estimate, so that's what given, the estimated cost of overhauling at the current prices is 3 lakhs. So no impairment at the year end. Okay, fine. Thank you. So this is a familiar question or familiar situation to you. So what are you supposed to do? What is the requirement here? I don't know what is the requirement. Should I calculate total cost? Should I calculate depreciation? Should I unwind the expense? I have no idea. So after reading that first case study, we are moving on to the MCQs. What are the MCQ questions here? 1. Which of the following items need to be capitalized in determining the cost of production line? Abnormal cost of 0.3 lakhs. Can you capitalize 0.3 lakhs? No. Recoverable GST, refundable GST? No, no, no. Initial estimate of the cost of dismantling and removing and restoration of item, it can be capitalized, but is it 2 lakhs? Your eyes will be definitely on the second last option also, 1.36 lakhs, which is the correct one. Yes, D. Option D is the correct answer. Okay. Now, calculate companies associate Flynet Limited's cash flow from operations. We don't know because we have not read that second and third case studies. What accounting treatment should be done by FA Limited's books for the year ending as the customer has taken legal action against? No, we have just read that first case study which is relating to the asset. So, 4. Compute total amount to be charged to P&L, statement of P&L with respect to production line. So that asset related, what is the expense to be charged to statement of P&L for the year ending? And balance of provision for dismantling cost carried to balance sheet. So do you remember the provision for dismantling cost at the beginning is 1.36. So you are unwinding for 1 year. Unwinding at 5%. So 1.36 plus 5%, 1.428 is the provision for dismantling cost. But there are 2 questions. What is the amount to be charged to P&L? What is the provision for dismantling? So 1.42 is here. So option C. Please don't conclude it is option C. Let's check. How do we check whether it is option C? First, what are the items? What are the items that will be taken to statement of P&L for the year ending related to the asset? Asset related expense in P&L is depreciation, as well as assets decommissioning expenses, unwinding cost, finance cost. Both will be taken to P&L. So what are the items? So first, to calculate depreciation, we need to find out the cost of asset. So 10 lakhs, correct. Recoverable GST, no. Employment cost, 1.2 divided by 3 into 2.8. Overhead expenses, 0.9 minus 0.3, 0.6, 0.5, Expected dismantling cost, not this figure, 1.36. 10 plus 0.6 plus 0.5 plus 1.36. Total, if you're trying there, is it coming to 13.26? Yes. So 13.26, what is the useful life? 8 years. Of that 8 years, one full year depreciation can you claim? No, because April, May was the construction period. Asset is ready to use only from 31st May. So from 31st May, 10 months. April, May, if we exclude, 10 divided by 12. So, but you are remembering, yes, this includes 3 overhauling cost. Balance is 10.26. A significant item having a significant different useful life has to be depreciated separately. So, for 3, useful life is 4 years and 10.26 useful life is 8 years into 10 by 12 into 10 by 12. So, depreciation is coming to 3 divided by 4 into 10 by 12. 0.625. 0.625. 10.26 divided by 8 into 10 by 12. It is 1.06875. 0.625. Total is 1.69375 is the depreciation. So another expense at the year end is I'm sorry. 1.36. 1.36 is the provision for dismantling into 5%. 1.36 into 5%, 0.068. So total 1.69375. 1.76. So option. Yes, option. So 1.76. 1.76 and 1.42. Option C. See, but how much time you are taking? How much time I have taken for 1 mark? Okay. But the next one is bit easy. Compute the cost of production line to be capitalized. 13.26. So question number 1, 4 and 5 is related to the first case study. Okay, fine. It's fine for us. Then 2. See, what I'm trying to tell you is have a very good level of presence of mind and then read. During the year ended 31st March 13, FA Limited provided consultancy services to customer regarding the installation of new production system related to aircraft parts. Okay, so our company is providing consultancy services also. The system has caused the customer considerable problems. Oh, so the customer has taken legal action against the company for the loss of profits that has arisen as a result of the problems with the system. The customer has claimed damages to the tune of, 1.6 lakhs. The legal department of FA Limited consider that there is a 25% chance that the claim can be successfully defended, which means there is a winning probability of 25%. So if winning probability of 25% means, do you need to create provision or contingent liability? Please don't jump into the conclusion saying that 25%, so contingent, less than 50% probability. 25% is winning, which means 75% is losing. So more probable to have, there can be outflow of resources embodying economic benefits. It is more probable. So you need to create provision. The legal department further stated that they are reasonably confident the company is covered by insurance against these type of losses. So what? There can be a reimbursement received, but now the accountant feels nothing needs to be provided for this claim as the company is suitably covered against any possible losses. So as per Ind AS 37, provision needs to be recognized. When? How much provision we need to, or when do we need to create provision? When there is present obligation as a result of past event. Outflow of resources embodying economic benefits are more probable, more than 50% chance. So again, don't get confused with that 25%. 25% is winning, 75% is losing. So we are creating provision for that more than, because there is more than 75% probability. Best estimate can be reliably measured. So what accounting treatment is to be done? Nothing to be provided. Wrong. Provision of 1.6 lakh should be recognized. Yes. Provision of 0.4 lakhs. No, it's not point. From where you get this 0.4 lakhs? Maybe 1.6 into 25% calculation. No. Contingent liability to be disclosed. No. So answer is option number B. I hope that's okay. So there is only one question from that case study. Then case study number 3. FA Limited has an associate company. Okay. Flynet Limited. Following are the information of Flynet for the year ended. Net income after taxes. Decrease in accounts receivable, depreciation, increase in inventory, increase in trade payables, decrease in wages payable, tax charge for the year, P&L, profit from sale of land. So what is the question? Flynet Limited. Do you remember? Calculate, second MCQ, calculate companies associate Flynet Limited's cash flow from operations. Cash flow statement in day 7. How do you calculate? Income after taxes, 120. Then, actually we need PBT, but here income after taxes. So you add back tax. So anyway, because we're not preparing, we just need the cash flow from operations. Decrease in trade receivables. Do you remember? Working capital changes. Add a decrease in current assets and increase in current liabilities. Add. Decrease in accounts receivable means you have received cash from trade receivables. Depreciation, non-cash expense you add. Increase in inventory. Increase in inventory means you purchase, that's outflow. Minus 10. Increase in accounts payable. Current liabilities increase, which means you have not paid cash. Cash is in the business. Plus 7. Decrease in wages payable. Wages payable decrease means you paid. Oh, so it's just about working capital changes. Basic cash flow statement, indirect method. Not statement, just answer. Decrease in wages payable, minus 5. Tax, deferred tax, whatever it is, tax charge for the year. If it is deferred tax, again it is non-cash. So add. So this has to be added here itself. So we would have received PBT, profit from sale of land, credited to P&L. So profit from sale of land is investing activity. So remove minus 2. 120. Oh, maybe 120. Oh, maybe 25. 120 plus 20 plus 25 minus 10 plus 7 minus 5 plus 15 minus 2. 170. 170. Option B. Option B. 170 is the correct answer. You please check with the answer. You have the RTP. You please correspondingly check the answer. Okay, 170. Option B is the correct answer. So here, option D, B, B again, C, and A. These are the correct answers. Okay, fine. But now we have just got 5 marks. Just move on. Let's move on. Case scenario number 2. Okay. HS Limited, HSL, is a car manufacturing company. During the year, HSL has entered into many transactions, details of which are given below. Okay. With the intention to expand, HSL has entered into a share purchase agreement with shareholders of FM. Okay, fine. With the intention to expand, HSL has entered into a share purchase agreement with the shareholders of FM Limited to purchase 30% stake in FM as at 1st June 2012 at a price of 30 per share. Okay, fine. As per the terms of this agreement, HSL has an option to purchase an additional 25% stake in FM on or before 15th June 2012. Oh, that is potential shares. So you already acquired on 1st June 2012 30% shares. Plus you also have an option to buy another call option. Maybe you are the holder of call option to buy another 25% shares at a price of 30. Similarly, selling shareholder has option to sell 25% stake on or before. Okay, there will be a writer also. The decision on relevant activities of FM are made in AGM or EGM. Resolution in EGM is passed when more than 50% votes are cast in favor of the resolution. An AGM can be called by at least 21 days advance notice to all the shareholders. So what is the requirement again? So 6, 7, no, 8, 9. This is the only question from this case study. What is this? With respect to SPA, share purchase agreement entered into by HSL Determine the date when HSL gained control over. What is the, okay, control is there. Why control is there? Because as per the agreement, you have already 30% share. Also, you have a call option. You are the call option holder to sell additional 25% shares. So, 55%. So, control is there. What is the date of control? So, 1st June itself should be considered, because on that date when you entered into the agreement itself, you have, normally in the study material question, this option is deeply in the money or out of money, that kind of information will be given, but here nothing is given. So, which, assuming it is deeply in the money and it will be exercised, then 1st June itself you got that power, you got that 25% additional 25% right. So it's 30 plus 25 as per Ind AS 110. If you have potential, if you have already entered into a contractual arrangement to buy potential shares, that's fine to count control. So from 1st June itself. Okay, fine. Then case study number 2. During the year, HSL issued compulsory convertible debentures. Compulsory convertible debentures on a private placement basis for 100 lakhs. Each CCD is convertible into 5 shares at the end of 4 years from the date of issue, and an annual interest is payable at the rate of 6% per annum. The at initial recognition, HSL recognized a liability component is 20 lakh 79,063 is the liability component. HSL also incurred expense of 2 lakhs in connection with the issue of the instrument. So what is that 2 lakh expense which is incurred in connection with the issue of this compound financial instrument? Yes, I can hear you saying transaction cost. Okay, fine. Nature of expense includes fees to legal advisors, registration and regulatory fees. So again, what is the question? 2. What shall be the accounting treatment of this directly attributable expense of 2 lakhs incurred in connection with the issue of compulsory convertible debentures? See, do you remember, if you incur any transaction cost on compound financial liability, divide that transaction cost or allocate the transaction cost to equity and liability. Allocate the transaction cost to both equity and liability in the ratio of their respective fair values on the date of issue. So, what are the entire 2 lakhs shall be recognized as expense in statement of P&L? Wrong. Entire 2 lakhs shall be reduced from equity? Wrong. A proportion of 158,419 shall be reduced from equity and 41,581 shall be recognized as interest cost over the period of 4 years using effective interest method. May be correct, but we have to calculate. Entire 2 lakh shall be recognized as interest cost over the period of 4 years. No. So maybe the correct option is option C, but we'll definitely calculate. How do we calculate? Total amount issued is 100 lakhs. Okay, 100. Of which liability is 20.79 for the time being. Just for verifying, I am taking only 20.79. So 100 minus 20.79 is 79.21. So the expense of 2 lakhs will be allocated 2 lakhs into 20.79 divided by 100. So 0.4158 or 41,580 and 1,58,420. So balance 1,58,420. So we are allocating in 20.79 divided by 100 to liability and I've taken just the balance. So let me check the option. Correct. These figures are correct. Option C is the correct answer. Option C. Okay. Now, HSL acquired 40% stake in NM Limited as at 1st January 2012. 40% stake acquired means which standard will be coming into the purview? Ind AS 28. Okay. On 1st Jan, as at 1st January 12, on date of acquisition, for 8 lakhs cost of investment, classified the investment as an associate, understood. As at 1st January, carrying amount and fair value of plant and equipment is January. Okay, you on as per Ind AS 28, on the date of acquisition, you need to compare cost of investment with the share of net assets. So, and when you take the share of net assets, you should take the fair value of net assets. So, fair value of net assets is 5 lakhs. So, there is a difference of 2 lakhs. Do you remember what we do? In most of the questions, this adjustment is there. So, this 2 lakhs should be, that additional cost of 2 lakhs should be spread over the remaining life. Additional depreciation will be charged. Anyway, let's see. For the remaining life of 5 years. 5 years is 20 quarters. Why quarters are given? From first, you acquired on 1st January. 31st March is the reporting date. NM Limited generated a profit of 50,000. So the question will be, what is the carrying amount of investment? This is a very easy question. So we'll say as per Ind AS 28, carrying value of investment is calculated initially at cost. Then we'll add additional profits earned during this period is post acquisition profits is 50,000. But you take only your share. What is your share? 40%. 20,000. You have an additional, 20,000 profits is added, but there is an additional depreciation also to be adjusted. So, 2 lakhs divided by, now we need to do only quarters. 5 into again 3 by 12. Why do you need to do that? 20. So it is additional 2 lakhs divided by 20 into 40%. You will deduct 4,000. So 8 lakh 16,000 is the carrying value of investment, but we don't know what should be the carrying value of investments. 8 lakh 16,000. Carrying value of investment is 8 lakh 16,000. Okay. Now we have one more last case study. So what is this last case study? While selling a car, HSL provides a trade discount of 1% on sale price, which is mentioned on the invoice. HSL provides a credit period of 7 days to its customer. However, if paid upfront, then HSL gives an additional cash discount of 2%. HSL provides a voucher worth 500 with validity of 1 year, which can be used at an apparel store. Okay. So this is a question on Ind AS 115. Let me read once more. While selling a car, we provide 1% trade discount. Then we provide 2% cash discount. See, when as per Ind AS 16 or Ind AS 2, this cash discount will not deduct. But as per Ind AS 115, as per Ind AS 115, okay, as per Ind AS 115, come on. Transaction price is the expected consideration. Transaction price, what is the keyword I used to say? Consideration. Expected to be received. Consideration expected to be received. So what is the consideration expected to be received? When I sell something, I'm sure there is a trade discount and there can be additional cash discount. So that is also not, I'm not expecting that the customer should pay. I'll be giving that cash discount. HSL also provides a voucher worth 500 with validity of 1 year. So, which can be used at an apparel store. So that discount also we are not expecting to receive. That will not recognize as our revenue, 500 rupees. So what is the question? How should HSL account for trade discount, cash discount and voucher? Trade discount shall be reduced from the revenue. However, cash discount and value of voucher shall be charged as expense. No. Trade discount and cash discount both shall be recognized, but voucher will be charged as expense. Trade discount, cash discount and value of voucher will be recognized as expense. Trade discount, cash discount and value of voucher will be reduced from the revenue. This option D is the right answer, but still if you have a doubt. What is the treatment of regarding that discount voucher? That voucher can be considered as you have done a question like voucher can be considered as an additional performance obligation when that performance obligation discharged only that revenue. That is actually based on another purchase. But here there is no another purchase. There is no another transaction. We'll be giving that 500 rupees voucher. There is no condition attached to it. And again, what is the adjustment of this discount? What is the treatment of this discount? So come on everyone. What are the treatments of discount as per 115? Is it addressing the treatment of discount? Yes, very much. As consideration payable to customer. Oh, consideration payable to customer. If you remember the consideration payable to customer, if the discount is related to a distinct goods or service, is that discount relating to for getting a distinct goods or service? Is this discount given? Nothing is mentioned regarding distinct goods and services, not related to distinct goods and services. If it is not related to distinct goods and service, adjust against transaction price. Do you remember? You have to remember, guys, you need to adjust this trade discount, cash discount, vouchers. Voucher cannot be treated as a separate PO here because there is no additional promises we have given along with the voucher. So it should be, there is no additional purchases, nothing. So we have to adjust all the three discounts. So the answer is option number D. So question number 9, with more acquisitions at the end of the year. HSL has investment in 2 subsidiaries, okay. 3 associates, fine, and 1 joint venture. Oh, 2 subsidiaries, 3 associates and 1 joint venture. Which of the following statement is correct? Okay. HSL is required to measure all such investments at cost. No. This is actually a question on Ind AS 27. Separate financial statements. So in the books of the investor, there are subsidiary companies, there are associates and joint ventures. So there is investment account in separate financial statements. How it should be measured? It should be measured either at cost or it can be measured as per Ind AS 109 at the option of the investor. The option is given to the investor. So to record all these investments at cost, wrong. It has an option to account the investments using equity method. No, equity method is in CFS and carry subsidiaries at cost. No. HSL has an option for each investment to measure either at cost or in accordance with 109. Okay. HSL has an option to measure all such investments. All such investments should be measured either at cost or in accordance with 109. The option is available for each category of investment separately. Correct. This is more clear. That is subsidiaries either at cost or as per Ind AS 109. Associate and joint venture also you have an option. So all you need not either all 3 at cost, all 3 at 109. Such a point is not there. So this is more clear. The option is available for each category separately. But HSL has an option for each investment to measure either cost. But this is more clear. So we'll go with option number D. Option D. Okay. with respect to SPI, yeah, 1st June. Fine. So that takes care of MCQs. There are 10 MCQs and it is giving an idea that the MCQs which will be asked for exam could be this more or less this kind of question. Case study MCQs. Okay. Then question number 11. Trust me guys, this is illustration number 11 in business combination. Associate becoming subsidiary. Generally our initial type of question, or this is the same type of question. It was an associate, step acquisition, acquired further person. So what are the accounting treatments? Let's see quickly. And this type of question has already asked in May 2019. May 2019, this question was already asked. So let's see this. On 1st April 2011, okay, Pride Limited acquired 30% of ordinary shares of Famous Limited for 4,000 crores. Pride Limited accounts for its investment in Famous Limited using equity. Of course, 30% share in Ind AS 28 is attracted. Therefore, you have to go for equity method as prescribed. On 31st March 12, Pride Limited recognized its share of net assets using equity method as follows. So, initially at cost, then add share of profits. So, they added 350, 50, exchange difference in OCI, revaluation reserve 25. So what are the journal entries to be passed here? Investment to P&L 350, investment to exchange difference in OCI 50, investment to revaluation reserve in OCI 25. So investment will be debited with this much amount 425. The carrying amount of investment 4,000 already there. Investments to cash is already there. Plus investment to cash is there. Along with that there is additional that also has been added. 4425. On 1st April 2012, Pride Limited acquired the remaining 70% of Famous Limited for cash 12,500 step acquisition. Already you had 30% plus you acquired another 70%. What is the accounting treatment? So on this date, Ind AS 103 applies. Following additional information is given. 30 fair value of previously held interest, fair value of net identifiable assets. Determine the acquisition date. Come on, it is on 1st April, date of acquisition of control. Determine the gain on previously held interest. Already the investment is standing at 4425. Now the value is 4,500 and suggest the accounting treatment. So 4,500 minus 4425, 75 will be charged to P&L gain. Compute the amount of goodwill arising on acquisition. So how much is the PC? Purchase consideration. Purchase consideration is you paid cash 12,500 for 70% and add the fair value of previously held interest 4,500. So purchase consideration is 12,500 plus 4,500. It is 17,000 is the PC. So NCI, there is no NCI. How much is net identifiable assets? 15,000. So how much is goodwill? You paid more and 2,000 is the goodwill. And acquisition date, determine the gain on previously held interest and suggest the accounting treatment. Compute the amount of goodwill. Pass journal entries. So what are the journal entries to be passed? We'll write net identifiable assets debit. Net identifiable assets 15,000. Goodwill debit 2,000. To PC you paid cash 12,500. Eliminate investment from the books at 4,425. Then what we should not forget, an amount was, when the investment was there, correspondingly some amount was there in OCI, in exchange difference and revaluation reserve. Both is to be reclassified. Exchange difference is reclassified to P&L and what? Revaluation reserve will be reclassified to retained earnings. Revaluation reserve was how much? 25. So how much is to P&L? P&L, the gain of previously held interest, I forgot the figure, 75, and exchange gain of 50 must be 125. So is it tallying? 12,500 plus 4,425 plus 125 plus 25. 12,500 plus 25 plus no. So what is the journal entry for this? What is the journal entry? Journal entry, if you remember, net identifiable assets debit. I forgot. How much is net identifiable assets? So what is the journal entry for this? Net identifiable asset debit. Do you remember the figure 15,000? Yeah, correct. Goodwill debit 2,000. Yeah, correct. 2 investment, you please eliminate. How much was the investment? Book value 4,425. 2, that as a result there is a P&L profits of 75. Then we paid cash. How much cash we paid? 12,500, right? 12,500. Actually, this take care of your first entry. But here in the study material as well, they have done a combined entry. Most important, an amount is relating when you are eliminating this investment. Investment related, there is an amount in OCI. Revaluation reserve in OCI. And FCTR, foreign currency reserve in OCI, both requires reclassification. Foreign reserve will be reclassified to correct P&L. Revaluation reserve will be reclassified to retained earnings. So both they have passed the combined entry. So I'm just writing here foreign reserve in OCI, revaluation reserve in OCI. Foreign reserve 50 and this is 25. FCTR will be, let's add here 50, 125 and to retained earnings 25. So let's take the total 15,000 plus, yeah, 20, 50, 25. Yes, it's tallying. This is the entry. Actually, this is pakka, same question from the material. So we are not investing time on this. Question number 12. Professional and ethical duty of a chartered accountant. The new area added. So definitely this exam you will be getting from any of the 10 questions in the material will be a India's question, the same pattern of question like what is there in the study material. Let's read and find out. So let's read this question number 12. Astra Limited is a listed entity which operates in the defense and fiber optic sector. So we are focusing on this. But actually this is too irrelevant. But let's read. It supplies fiber optic cables and racks in the domestic country. This activity is only a trading activity for Astra as it procures. As I always say, start from the requirement. Discuss the potential conflicts which are arising in the above scenario and ethical principles that would guide Ms. Suparna Dasgupta in responding to the situation. So as usual, there is a general para given. This activity is so relating to company. This activity is only a trading activity for Astra as it procures good from pre-approved suppliers. But I really do understand students, because we will be reading what definitely we do not know whether this is relevant or irrelevant when we start reading the question, right? So, and after inspection, sells the goods to IT companies. The sale contract requires Astra Limited to deliver these goods to IT companies. Okay, payment terms are 30 days after the invoice to Astra. Okay, so they are dealing in some business. They sell products, and payment is within 30 days from the date of invoice. Okay, now listen. Miss Suparna Dasgupta, who's she? A chartered accountant, has recently joined Astra Limited as head of finance department. Oh. The Chief Operating Officer, that is COO, also the Executive Director of Astra Limited, is Miss Padmaja Srinivasan, a mechanical engineer with an MBA from Harvard University, who rose through the ranks through her excellent skills in project management, marketing, and customer management. Her remuneration includes a bonus computed as a percentage of turnover. So total turnover into percentage is also given to COO as bonus, and an additional incentive for achieving EBITDA in excess of 15% of turnover. Aha. Astra Limited has sold optic cables amounting to 2 crores. Invoice dated 31st March 2012 to Ethernet Bullet Limited. Actually, this is the area from where the question starts. A company providing high-speed internet connectivity services through fiber optic cables as well as dedicated leased lines. The service unit of Ethernet Bullet Limited is located next to the factory of Astra Limited. Okay. So we are selling it. Our customer is Ethernet Bullet Limited. As well. Okay, fine. The company provides high speed. Okay. Ethernet Bullet Limited is our customer. Though the goods were not moved to Ethernet Bullet Limited service unit, Astra Limited recognized the sale for the year based on the contention that the service unit is adjacent and hence the transfer can happen in a few minutes. Oh, what is this? I didn't understand. Actually, there was a sale on 31st March 2012. So, what we were saying, Astra Limited is the seller and Ethernet is the buyer, and Ethernet is our customer, and we sold on 31st March because we sold cables amounting to 2 crores. Invoice date is 31st March 2012 to a company providing high speed internet connectivity services through fiber optic cables as well as dedicated lease lines. The service unit of Ethernet Bullet Limited is located next to the factory. So in India's 115, we have studied something like this, like bill and hold. Though the goods were not moved to Ethernet Limited service unit, Astra Limited recognized the sale for the year based on the condition that service unit is adjacent and hence transfer can happen within few minutes. See, in bill and hold, what we have studied is 4 conditions are to be satisfied. The reason for bill and hold is substantive, that is buyer has requested to hold, the goods are identified, goods are ready for delivery, control has been transferred, but there is no other such information. What they are telling us, this customer's service unit is nearby, so at any time it can be transferred. It can be transferred, which means performance obligation has not been discharged. The annual results. So what they're telling, Astra Limited recognized revenue based on the condition that service unit is adjacent and hence transfer can happen within few minutes. That which means you have not discharged the performance obligation. There is no information about that buyer requested to hold or any other information. The annual results are due for board approval for the year ending 31st March and require sign off of Suparna Dasgupta. Suparna Dasgupta, there is a mistake here. They have recognized 2 crores revenue without discharge of or without transferring the control of the goods and services to customer. Suparna Dasgupta has been given 40% increment on joining. Oh, which enables her to comfortably pay off her housing loan and mortgage. Oh, Additionally, she is given perquisites in the form of business class travel, exclusive chauffeur-driven car, stock options. Accordingly, she has stated she cannot afford to lose his job, and perquisites are best in the country. So, conflict of interest. She knows that there is a mistake. They have overstated revenue. And but what if I report it, or what if the correct treatment is done? If there is a pressure from the COO, because COO Padmaja, what's her name? Srinivasan. Padmaja Srinivasan is getting bonus based on the percentage of turnover. So she must be insisting to inflate the turnover. So, and 15% of turnover. So, what is given? Again, Padmaja Srinivasan has communicated to Suparna Dasgupta that many more benefits will accrue if she agrees to present the numbers without any. Oh, if there is no modification, she will be getting more benefits. Oh, there's again pressure. She has also said that the company would not hesitate to replace Suparna Dasgupta should she disagree with the contentions above. My God. So discuss the potential conflicts. So it's actually a threat. And she doesn't want to change her job because the salary and perquisites are best in the country. So how do I answer this? Write the provisions of Ind AS 115. What is the correct treatment? What is the mistake and what is the correct treatment? Then write about ethical duties. Then what discuss the potential conflicts. Then from the question regarding that threat and what she is getting, actually from our FR point of view, Ind AS 115 provisions only. Then from auditing point of view, the final answer is that you have to write that close, but the final answer is that whatever it is, our chartered accountant should not be grossly negligent. She write about the professional misconduct, write about ethical consideration like integrity, objectivity, and all. So should report, should do the modification. That should be the final answer. Okay. So I hope that part is clear. Okay, let's do illustration 13. Ind AS 22 income taxes. No, it is Ind AS 12 income taxes, or AS 22 accounting for taxes on income. Joy Limited wishes to calculate tax base of its assets and liabilities as on 31st March 15. The balance sheet, so year is 31st March, year ending date is 31st March 15. The balance sheet date has been adjusted by current tax expense. Summarize balance sheet. So we are, okay, balance sheet we have PP, intangible assets, investments, trade receivables. Okay, fine. Depreciation expense for the year 14-15. Allowable in accordance with tax laws is 2,06,000. Accounting depreciation included in operating costs. So how much, what is given? See, what I'm trying to tell you is, when you answer a proper Ind AS 12 question, like we have this assets, liabilities, where we need to do a particulars column, then carrying value, tax base, and difference. You have to prepare a table like this. So carrying value, tax base, taxable temporary difference, or deductible temporary difference. So we need to prepare a table. So identify the differences, and on the net amount apply the tax rate. So deferred tax, if it is taxable temporary difference, deferred tax liability, deductible temporary difference, deferred tax asset. Okay, fine. So here, that's not the way I'm going to do. We'll be just discussing everything side by side, calculations we'll be giving. Depreciation expenses 2,06,000. Okay. Accounting depreciation included in operating cost is 1,70,000. Cost of PP is 16 lakhs. Okay, cost of PP is 16 lakhs. And Joy Limited has deducted expenses of 4,16,000 in the previous years, and current year expense deducted is 2,06,000. So 16 lakhs minus 4,16,000 minus 2,06,000. 9,78,000 is the tax base amount deductible in future. And moreover, on 31st March 15, Joy Limited for the first time revalued its PPE to 12 lakhs. Revaluation surplus is 88,000. Oh, which means if there was no revaluation surplus, asset value would have been 11 lakh 12,000. Also, there is a revaluation surplus. Why do you need to calculate that revaluation separately? Because on this difference, when I'm checking, carrying value is more than tax base. On this, what do we need to create? When carrying value of asset is more than its tax base, taxable temporary difference. That is, create DTL. When you create DTL, 1,12,000, 11,12,000 minus 9,78,000, 1,34,000 taxable temporary difference. The effect should be in P&L, and on 88,000 DTL effect should be in other comprehensive income. Anyway, here 134 plus 88. There is a taxable temporary difference of 2,22,000. Okay, fine. Taxable temporary difference, remember 2,22,000. In 2011-12, Joy Limited incurred product development cost of 1 lakh. 11-12. Current year is 31st March 15. 14-15 is the current year, and this is 11-12. 11-12, 12-13, 13-14, 14-15. 11-12, 12-13, 13-14, 14-15. 4 years later. These costs were recognized as an asset and being amortized over a period of 10 years. For tax purpose, it deducted full product development cost in 11-12. Okay. So I'm just checking quickly. Intangible asset is 60. I understand 1 lakh minus 4 years depreciation, 40,000. 10,000 into 4. Okay, fine. 60,000. Then what? Tax base is 0. Why tax base is 0? Because tax amount deductible in future, nothing is deductible in future. Therefore, 60,000. So 2,22,000 is the taxable temporary difference. 60,000 is the taxable temporary difference here. Now, what is next? Trading investments were acquired in 2013-14 with cost of 2,30,000. Okay, investments 2,30,000. These investments are classified at FVTPL and thus recognized at fair value. Fair value adjustments are not tax deductible. 2,30,000 is the cost. Okay. This is the cost, 2,30,000. In the tax base will be always cost. Okay, there is no fair valuations and all. But trade investments are appearing. Book value is 2,08,000. So carrying value of asset is less. You need to create deductible. This is resulting in deductible temporary difference. So 2,08,000 minus 2,30,000 on 22,000 DTA has to be created. So I'm just writing here PPE, carrying value, tax base, taxable temporary difference. This is taxable temporary difference or deductible temporary difference. So here first one is PPE. This is carrying value. This is tax base. PPE. Carrying value is 12 lakhs. Here it is 9,78,000. Taxable temporary difference of 2,22, right? 12 lakh minus 9,78,000. Yeah. Then intangible asset, 60,000 is the carrying value. Tax base is 0. Again, taxable temporary difference. Okay. Then on the next one, trade investments. Trade investments carrying value is 2,08,000, but tax base is cost 2,30,000. Carrying value is less. So in future, when you sell the investments, you will be getting deduction on loss. So there will be loss on sale. So deductible temporary difference is 22,000. Okay, fine. Then next item. Next item is actually good. Bad debt provision amounting to 1,30,000. So our trade receivables 6,26,000. Okay. Trade receivables 6,26,000, or I'll write here carrying value of trade receivables 6,26,000, and that is after deducting a bad debt provision of 1,30,000. That is relating to two debtors. Debtor A, 80,000 receivable originated in 12/13, and 100% provision was recognized in 13/14. Okay. Debtor B, 50,000. Oh, that is how 1,30,000, 80 and 50. Receivable originated in 13/14 and 100% provision in 14/15. Tax law allows deduction of 20% of provision for debtors overdue for more than 1 year, 30% of debtors overdue for more than 2 years, and remaining 50% for debtors overdue for more than 3 years. Be careful. Tax allows provision like this. If it is overdue for more than 1 year, 20%. Overdue for more than 2 years, 30%. And overdue for more than 3 years, 50%. So debtor A originated in 12/30. So in the previous year, so 12/13 tax will not provide any deduction. But 13/14, it is overdue for more than 1 year, right? It more overdue for more than 1 year, so they would have allowed a deduction of 20% of 80,000. And we are in current year. Current year is 14/15, overdue for more than 2 years. They would have allowed a deduction of 30% of 80,000. So total 50% of 80,000. 40,000 is allowed as deduction from debtors. Provision for bad, not provision, allowed as deduction. Then this is on account of A, and on account of B, originated in 13/14. So 13/14 they will not give any deduction. 14/15 overdue for more than 1 year, so 20%. 20% of 50,000, so 10,000. Total deduction they would have allowed us 50,000. Yes or no? So we are checking. Total 6,26,000 is the carrying value as per books. 6,26,000 plus 1,30,000 is the, actually it is originally 7,56,000 is trade receivables. Books allowed 1,30,000, so that is why 6,26,000. Tax law allowed a deduction of 50. Therefore, tax base is 7,06,000. Yes or no? Tax base is 7,06,000. That is 7,56,000 minus 50,000, which they have already allowed. So carrying value of asset is less. 7,06,000 minus 6,26,000. 80,000. Oh, total 1,30,000 provision. 50 allowed. So 80,000 more has to be allowed in future. So of course, deductible temporary difference DTA. Correct. Then Joy Limited accounts for inventory obsolescence provision. New provision created in 14/15 was 10,800. Inventory obsolescence provision, NRV. New provision is 10,800. So total provision is 18,000. This provision is not tax deductible as it is a general provision. Inventory. What is the amount of inventory? 3,04,000 is inventory. On inventory, they have created provision. Carrying value is 3,04,000. But there is a total provision of 18,000 on inventory. There is a total provision of 18,000 on inventory, but such a provision is not there in the tax records. So 3,04,000 plus 18, 3,22,000. Again, 18,000 deductible temporary difference concept. Concept is when you sell that inventory, you will end up in a loss. Then you will be getting tax deduction. So future tax deduction, create DTA. Okay. Then is it finished? No. Government grants are not taxable. Okay. Government grant received in 14-15 appearing in the balance sheet. Oh, there is a government grant. Grant received appearing in the balance sheet. Balance sheet where? Deferred income. So it will be credited to P&L over the period in which that conditions are to be satisfied, but it is not tax deductible. It is not taxable. This will not be taxable. So do I need to create any deferred tax asset or liability? No. No need to. There is no effect. There is no effect. No deferred tax asset or liability we are not creating. Future tax liability is there, not future deductions will be there. No. Then, it's 2 more points. In 14-15, Joy Limited made a further provision for product warranty 5,000. Further provision. So maybe already there is a provision. Further provision they created 5,000. Such provision for product warranty costs are not taxable until the claims are paid or settled. So you are selling some products, on that you give warranty. So in the books there is a warranty expense and provision, but that expense will be deductible only when that actual expense incurred. During the year 14-15, warranty claims are paid or settled for 6,200. So there is an opening provision. Current year you created again P&L2 provision. From that provision you paid 6,200. Current year you created 5,000, then you paid 6,200. So what is the... So there is a liability for product warranty. So further created, then paid, balance is 16,000. But such a 16, that amount is not there in tax records. So liabilities, provision for warranty. Provision for warranty. Carrying value is 16,000. Tax base is 0. Because again, carrying value minus amount deductible in future. When it becomes actual expense, it will be deductible, so 0. Carrying value of liability is more. Again, DT, deductible temporary difference. Okay. That hints you need to study and then see this. Okay. Then hints, what hints? Create deferred tax liability on taxable temporary difference when carrying value of asset is more or carrying value of liability is less, deferred tax liability, and reverse. That you need to study. Now, during the year 14-15, Joy Limited has introduced the health care benefits for employees. The expenses are allowable as deduction in tax only when benefits are paid, in line with Ind AS 19. Such liability is recognized in P&L when employees provide service. Oh, in books there is expense and provision, but expense will be allowed only it is paid. Such an expense is there. Health care benefits for employees. 70,000 is there. So again, health care benefits. Benefits payable 70,000. Tax records only upon payment you will be getting the deduction. So 70,000. So take the total. 2,22,000 plus 60, 2,82,000. 22,000 plus 80,000 plus 18,000 plus 16,000 plus 70,000. 2,06,000. Can you set off? Of course. If there is legally enforceable right to set off, and the settlement can be made on a net basis within the same tax jurisdiction. So set off, it is 76,000 net taxable temporary difference. And have they given the rate? 32%. 24 DTL. 24 320. So we will do in days 23, question number 14. PQR Limited is engaged in tourism business in India. The company has planned to construct a holiday resort qualifying asset at Shimla. Oh, we are constructing a resort in Shimla. The cost of the project has been met out of borrowed funds of 100 lakhs at the rate of 12% per annum at rupees 40 lakhs. 40 lakhs were disbursed on 1st April 12 and the balance of 60 lakhs were disbursed on 1st June 2012. So we have taken up borrowings 100 lakhs of which 40 lakhs we received on 1st April and 60 lakhs on 1st June. The site planning work commenced on 1st June 2012. Site planning work commenced on 1st June. So we have taken the loan on 1st April. Site planning work commenced on 1st June. Since the chief engineer of the project was on medical leave, the company commenced physical construction on 1st July 2012. Loan 1st April, but site planning work commenced on 1st June. Company commenced physical construction on 1st July and work of construction continued till 30th September 2012. And thereafter, the construction activity stopped due to landslide on road, which leads to the construction site. The road blockages have been cleared by the government machinery by 31st December 2012. Construction activities have resumed on 1st January 2013 and has completed on 28th February 2013. Okay, so 30th September, 1st June, construction started, site planning work started and it got finished by February 2013. The date of opening has been scheduled for 1st March, but unfortunately the district administration gave permission for opening on 16th March 2013 due to lack of safety measures like fire extinguishers which had not been installed by then. Okay, determine the amount of borrowing cost to be capitalized towards construction of resort when landslide is not common in Shimla and delay in approval from district administration offices, minor administrative work left over. See here we need to apply Ind AS 23 provisions. When do we commence capitalization? We commence capitalization when 3 conditions are satisfied. Borrowing cost is incurred, expenditure has incurred, activities are in progress. Activities for making the asset in ready to use condition are in progress. So if that is checked, borrowing cost is incurred from 1st April onwards. Activity site planning work commenced on 1st June 2012. No information regarding when expenditure incurred. Let's assume expenditure also incurred. Upon site planning work commenced means of course expenditure would have incurred. Here construction physically commenced on 1st July. So that is okay. Site planning work is started means from this 1st June 2012 onwards you can start capitalizing and given it's a qualifying asset. So we can start capitalization from. So first you write the provisions of commencement and capitalization can be started from 1st June 2012. Then what they have given us, 1st June 2012 to 30th September 2012, construction continued. And thereafter construction activity stopped due to landslide on the road. Okay, this is our construction site and there is a road. There was a landslide on the road. It's a natural calamity. And the road blockages have been cleared by the government only. For 30th September to 31st December, the work activity during the extended period has been interrupted due to avoidable, unavoidable reasons. So here they are telling it's a natural calamity. Generally, we treat natural calamity as an unavoidable reason. So the question is, can you suspend capitalization from 30th September to 31st December? So what is given here? Landslide is not common in Shimla. So that is, so in case of a natural calamity, if it is common, natural calamity which is common, do not suspend. Oh, if it is common, suspend capitalization. Oh, natural calamity also, if it is not common, suspend. If natural calamity which is common, do not suspend. That is already assumed, already that also is already considered. So do not suspend, that is common. Continue capitalization. Okay, fine. So just I'm showing you the answer. No, this is question number 14, right? 14, yes. So first you should write about commencement, then suspension, then cessation. That is what. So in the given case, first, since the site commencing project 1st April, 1st June, 1st June onwards. So first answer, when landslide is not common in Shimla and delay, this I didn't discuss, delay in approval from district administration offices, minor administration work left over, then you cease capitalization. Substantially all the work is completed, so cease capitalization. So capitalization should be done from 1st June to 30th September. Okay. Then suspend capitalization for 3 months. December, till December you suspend. And then, so 1st June to 30th September. And then 1st January to which date? 28th February. So accordingly, borrowing cost is to be capitalized effectively for 6 months. And then, so borrowing cost is 100 lakhs. Because by June you received entire 100 lakhs into 6 by 12 into 12 months. June, July, August, September, January, February. 6 months into the rate. Okay. Okay. Phase number 2. Landslide is common in Shimla. If it is common in Shimla from 1st June to till the date of, that is in between, during that natural calamity, which is common, you need not suspend, continue capitalization. But and delay in approval from district administration officer, this major administrative work left over. Oh, major work left over means you cannot cease on which date? 28th February. Then what we should do? The date of opening has been scheduled for 1st March, but unfortunately the district administration have given permission for opening only on 16th March, which means that work during that 2 weeks is major. So it's work is not substantially completed. So you should capitalize from 1st June to 16th March. So 100 lakhs into how many months? June, July, August, September, October, November, December, January, February, March 15. So 9.5 months interest. So you should capitalize 400 lakhs into capitalization of the borrowing cost will be for 9.5 months. Is that okay? So if it is common, landslides are common, there shall be no suspension. You please study it. If there is a natural calamity which is not common, suspend. Natural calamity which is common, do not suspend, continue capitalization. Okay, understood. So that was which question? Question number That was question number 14. Now question number 15. Okay. Financial instruments and Ind AS 10. Let's see. The company has made a sales of 60 lakhs to customer SSLLP on 31st December 2012. Okay, there is a sale. The normal credit is for 1 month. Okay. However, sometimes it goes up to 2 months. So 31st December we have made a sales. The credit period is 1 month and sometimes it goes up to 2 months. The company expects to receive the payment by, so therefore 2 months, 28th February. However, no payment has been received till 31st March 2013. On 15th, so which means payment is overdue, on which you can create ECL, expected credit loss. There is an impairment on this financial asset. On 15th April, the sales department of the company became aware that the customer is passing through financial crisis and has major cash flow problems. An event occurred after the sales department became aware. You have not received, condition was already existing because you have not received the payment, and you became aware that the customer is having major cash problems, that he is in financial crisis. So you can create ECL on, it's an adjusting event. Condition was already existing and an event provides additional information or additional evidence for the condition existed. Company agreed to allow customer to settle the debt by, we are giving of, you are so understanding, so you have given a credit of 12 months, 1 year, by which time the customer is confident that the cash flow problem will be resolved. The company expects that an annual interest of 9% can be received against any money lent out. It allowed the customer an interest-free payment period. So now 60 lakhs is receivable. It will be received only after 1 year and we are giving interest-free. If 60 lakhs we have given as a loan to any other person, we would have received 9% interest, which means we are foregoing this 9% interest. What is the amount that is to be shown as trade receivable in the books? Oh, it's so simple question. It's a very easy question. Contract, how much is ECL to be created? Contractual cash flows expected. Contractual cash flows expected is 60 lakhs. And what is the present value of expected cash flows? We expect 60 lakhs itself, but only after 1 year. So 1 divided by 1.09, 0.9174. 60 lakhs into 0.9174. 55 lakh 4,400 is the amount of trade receivables will be shown. The difference will be written off as expected credit loss. 4,95,600 P&L to ECL will write. Will recognize. Okay, so this is a basic question. 16. In days 2, inventories. Okay. B Limited has valued its stock held for distribution as free items. Held for distribution as free samples, free items, that is at zero price. Cost will be there, say for example 100. Net realizable value is 0. If there is stock held for distribution as free items, it should be recognized at NRV 0. Customers have right to claim free item within 14 days from the date of invoice. If the time limit of 14 days exceeds, the claim is foregone by the customer. The majority of the free item requires online registration by the buyers for participation in the contest conducted by the respective brand, which needs to be done by the buyers within 3 days from the date of invoice. Out of it, a few items under this category were found damaged. The replacement cost of such items, or some of our free samples got damaged, and to replace it, we need 2,50,000. Determine whether the entity has to book loss of inventory or provide for replacement cost of goods that need to be given as free items to customer as per the principles of Ind AS. See, for this, whether they need to create, because NRV is 0, right? So, to replace this, we'll incur 2,50,000. See, we have a present obligation to customers. We have present obligation to customer because of a past sale. And we have to give this free samples. And to replace this, we have a cost of 2,50,000. So you definitely need to create a provision of 2,50,000 even if that inventory would be recorded at zero, but to replace it, there is present obligation of 2,50,000. Create provision 2,50,000. See, I'm discussing the contents. You read the detailed answer, but this is the content. Okay. So whether the entity has to book the loss of inventory, of course, and create for replacement code, that is to be created. So you need to book loss of 2,50,000. Okay. Then cash flow statement. Actually, statement of cash flows, but this question is very simple. Straightforward. Let's find out. Non-current assets. Non-current assets, intangible assets, etc. For this, this is actually investing activities. Deferred tax asset, there is no change, so no impact. But it is non-cash. Other non-current assets are expected to be of operating activity related. Other non-current assets. Financial asset investments, trade receivables. Okay, let's see that a balance sheet is given. Additional information. Profit before tax is 200 lakhs and provision for tax is 40 lakhs. Profit before tax 200 and provision for tax is 40. So 160 is PAT. So other equity 820 has become 980. 820 minus 980. 160 is the PAT. So profit before tax is 200. Okay. PP purchased during the year is 100 lakhs. PP purchased during the year. So opening PP was 410. Purchased 100, so it should have been 510. But closing is only 450, means 60 is the depreciation charge during the year, which is a non-cash item to be added back. Okay. Current liabilities include capital creditors of 25 lakhs as at 31st March 13. 31st March 12 nil. So it is nothing but capital creditors are included. What do you mean by capital creditors? You purchased an asset, right? You have not paid. So the straight payables include capital creditors. So when you compare the 455 minus how much was the amount? 25. 25 is to be deducted. 25 is to be deducted because this includes a capital creditors. See, working capital changes means current assets, current liability movement, if any payable to capital creditors are to be excluded. Okay. Long-term borrowings raised during the year. Long-term borrowings raised during the year is 120. So loan taken as financing activities. So loan 300 plus 120, 420 should have been the balance, but only 360 is closing balance, means you repaid 60. Okay. From the information, prepare statement of cash flows from indirect method. Assume bank body is an integral part of entity's cash management. See, what is the treatment of bank body? If it is integral part of cash management, it is a cash and cash equivalent. Negative cash and cash equivalent. Not integral, take it as financing. Loan taken, additional loan taken or loan repaid, etc. So, cash flow statement. It's a very easy cash flow statement, like an intermediate level question. So what we need to do is start with cash flow from operating activities. Profit before tax is 200, 160 plus 40, 200. Add a depreciation. Then working capital changes. Other non-current assets also operating adjustments. We have, so decrease in assets and increase in liabilities. Add. So same set of inventories, increase, deduct. Trade receivables reduced, add. Other non-current assets, any other non-current assets, you should treat it as, you should take here. Therefore, increase in other non-current assets, deduct. Increase in other current assets, also deduct. Increase in other non-current liabilities, trade payables, other current liabilities, now cash generated, cash flow from operating activities. So usually cash generated from operations, from that we'll deduct income tax paid. Income tax paid, there is no information. Investing activity, there is purchase of PP. 100 lakhs is the purchase of PP, but 25 not paid. Oh, okay. Cash paid for investments, acquiring investments, investment has increased. Cash used for investing activities. Financing, issue of equity share is there. Long-term borrowing and repayment. So net increase in cash and cash equivalents. Add opening, so we'll get the closing. So seriously, I'm telling, it's an intermediate level cash flow statement. So intermediate level cash flow statement, basic adjustments, nothing great. So that's why we are not trying it, just discussion is enough. And we are finishing question number 17, 18, 19, 20. 18. There is a on 115. There is a sale contract. A property sale. Maybe you are selling a flat or apartment. You are the builder and you are selling a flat. There is common area. That sale contract includes common. We'll be selling the common area portion. We'll be giving construction services and building material, also part of the cost. Property management services, golf membership, car parking, land entitlement. Whether they could be considered as separate performance obligations. So first, here you are required to write what is a performance obligation. Performance obligation is a promise to transfer goods and services. Performance obligation is a promise to transfer goods and services. When each promise is distinct, the promise is separately identifiable and the customer can get separate benefits. And 3 negative conditions, not integration services, not significant integration, no significant customization, not highly interrelated. Then 2, that is distinct, customer can get separate benefit and it is separately identifiable. And 3 negative conditions satisfied, it is a separate PO. But when I check common area, how can it be a separate PO? Whether the customer get separate benefit. To access the building, I have to use that common area. So definitely it is not a separate PO. Then construction service and building material. No. So that is what I'm acquiring. Then property management services. See, in most of the apartments, they will collect every month for services, property management services. So, the answer they have given, likely this is a separate performance obligation because the customer can get separate benefit of this services. And golf membership, if you are acquiring a building, you have to acquire this management services and you have to acquire golf membership. No. So it's an additional benefit for the customer. So it can be treated as a separate PO. Car parking. So there are flats without car parking or with car parking. You may have to park outside. So here these two, they have written analysis required. Analysis required, and they have written a safe answer like land entitlement and car parking. They have written, if the customer is getting separate benefit, if the customer is, if that benefit can be separately identifiable and not highly interrelated, but it is highly interrelated, right? That building and that property and that land is highly interrelated. So it's better not to treat it as separate PO. But thankfully, it's not an MCQ question. So you can write diplomatically, write the conditions. If that is satisfied, yes, or else no. So here, these two are treated as separate POs. These two analysis required. maybe. These two are not separate PO. Okay. Then, Ind AS 110. This is same test your knowledge question number 12. At the beginning of the current financial year on Ind AS 110, AB Limited holds 90% equity interest in BC. During the financial year, AB Limited sells partial disposal with the loss of control. 70% shares sold for a total consideration of 50. Even the amounts are same. So disposal, bank, debit 56. Fair value of 20%, interest retained, investment, debit 16. Derecognize, so no consolidation required, derecognize net assets 60 crores. Derecognize NCI, already NCI 10% was there. If the net worth is 60, NCI is 6. So 56 debit. Investments at fair value because it's only 20% debit. Plus NCI derecognized 78 minus 60. So gain on sale of sale of investment with loss of control. P&L credit 18. Then the net assets includes debt investments classified as FVT OCI and OCI reserve is 6 crores. So investment we have that entire net assets we have derecognized. So that investments in that there were some debt investments. On account of that debt investment, there is an FVT OCI amount is there 6 crores. Of that 6 crores, 90% was holding company's share 5.4. So finally what we are trying to say is when this debt investments which are classified as FVT OCI, the amount fair value reserve in OCI should be reclassified to P&L. P&L, reclassify 5.4 crores to P&L, OCI to P&L, OCI credit balance to P&L. Net defined benefit liability in AS 19 has resulted in a reserve relating to net measurement loss of 3 crores. So there is a loss of 3 crores in OCI. Of that 3 crores, 90% was parents, 2.7 crores. Recycled to or reclassified to retained earnings. In AS 19, retained earnings. So we'll pass the entry retained earnings to OCI 2.7. Because it was a loss, OCI had a debit balance. So cancel it means credit, retained earnings debit. So this question is purely on reclassifications. Then equity investments classified as FVT OCI. 4 crore. 4 crore is there. Equity investments classified as FVT OCI reclassified to retained earnings. So OCI to retained earnings. Foreign operations, FCTR reclassified to P&L. In CFS, 90% of the above reserves were included in equivalent equity reserve balances with 10% attributable to NCI. What would be the accounting treatment on loss of control? Pass this journal entry, then reclassification entries. That's it. Very easy, straight from study material. So that is why I'm not giving much importance. This question is super easy. 20. Fashion India Limited entered into an agreement with a company on 10th August for purchasing a machinery. The agreement closed that FIL Limited will have to settle the consideration of machinery by issuing its equity shares. FIL agreed to the close and order was confirmed. Machinery was supplied via invoice dated 25th October 2012 and delivered on 1st November 2012. Agreed PC is 150 lakhs and fair value of the machinery supplied is 160 lakhs. As agreed, FIL issued 1 lakh equity shares. So you purchased a machinery. Fair value of the machinery is 160 lakhs and against which you issued equity shares. So as per Ind AS 102, what should be the price and date of recording machinery purchase from RFD Limited? See, as per Ind AS 102, if the shares are issued to employees, non-employees, If shares are issued to employees, expense is measured at fair value of option issued. Fair value of options issued is our expense. But for non-employees, if goods and services are received and we are issuing shares, fair value of goods and services received and the date when it is received. So what would be the price? 160 lakhs. And delivered on 1st November. Accounting is on 1st November. Is it? Yes. 160 lakhs and on 1st November. So that's with RTP 2024. As I told you, nothing great. Very easy set of questions. Hopefully this May 2024 attempt will be also easy. For that, after seeing the paper, you should not repent. You should not repent, oh, these questions were easy, but I am not able to do because I have not studied well. That kind of feeling should not be there. So please do prepare well, guys. All the best. Thank you.